Welcome to the May edition of the Galileo Monthly newsletter. You'll see from our backgrounds that we're in a very different environment, I guess, in the new COVID world, and so we're doing this in a new way. With me, as I hope you can see, is Theo. Welcome, Theo.
Hello, Warren. Welcome. It's certainly not the normal way and the normal way of doing business, but I guess everybody will have to adapt.
And I think, on that note, just to thank all our clients, for adapting so quickly to the new environment. We've been, really busy. I think having lots and lots of conversations on Zoom and Teams and Skype and the like, and it's amazing how quickly our clients who were born before the 80s are adapting to this new world. So congratulations and thank you for your willingness to work with us in this time. Theo, I thought we should probably talk about a few things. A heck of a lot has happened since the last newsletter, and I think the world's in a very tricky state. But for now, I thought maybe you could just give us a bit of a view on the sort of lockdown world at the moment. We're in stage 4. I think the pressure on government is certainly changing. From an initial stage where the consensus was quite positive. There were a lot of compliments to government around how speedily they were acting, and my sense is that that's certainly starting to change as we see more loopholes and more gaps in some of the logic that some of the ministers are displaying on their press conferences, and some of the rules which are perceived to be arbitrary. And potentially now we're seeing more and more companies going into liquidation or business rescue. Comm is a notable one. What's your sense now of what's going on within government? Do you think they're starting to adapt their strategy?
Look, Warren, I think government would like to get to level 3 as soon as possible. And I think they're not hiding that. At level 3, there'll be enough economic activity to at least get the core of the economy moving forward. So that's from a government point of view, level 3. It might not mean that everybody will get to level 3 at the same time. They've said quite a number of times that it might be regional, it might be sectoral, and it might not be everybody at the same time, but the government would like to get to level 3. The point with government strategies, remember, the lockdown and flattening the curve is not part of the solution. It's part of making the solution possible. And the phase that we were in now was trying to buy time to understand the problem, to put measures in place, to have companies adapt, have people adapt, have behavior adapt, get the medical industry focused, so that once you move into economic activity, at least you gear towards that. But I think we need to be very careful. Economic activity on the one side will result on the focus on social distancing being compromised, and we cannot get away from that. So it's almost like the pressure valve would be the number of hospitalizations and probably the pressure that the health industry is in. So government would like to get the economy moving as fast as possible without this pressure valve going into the red. And this is going to be a balance. Remember, this balance between the health services, lockdown, and economic activity is not a South African debate. Far from it. It's a worldwide debate. There's one of the islands in Japan had to go back into lockdown after 26 days of being out of lockdown. So be careful. This is going to be a measured approach for the time to come. The end result, when this will end, and I think people need to appreciate it, we are at least probably 12 to 15 to 18 months away, but it will only end when there is a vaccine that will make that will assist people in not contracting the disease. But that's going to take time, it's going to take planning, and it's not with us in the foreseeable future. If it's shorter, it's a bonus, but we'll need to adapt our lifestyle for at least probably the next 12 months. In the end, this is a biological problem, and it'll be solved by medical science. And don't underestimate the tempo with which medical science is trying to address this.
I think maybe just for our clients, that doesn't mean that we're necessarily saying we'll live in lockdown for the next 18 months. It will be, I think there's some tricky legal implications of extending lockdown beyond July, because that would require a vote by Parliament, is my understanding. And I think that will be a real tricky one. So let's hope that we're looking at weeks before lockdown is reduced and potentially ended. But as you say, the long-term solution for the SA and global economy is certainly a medical solution. So I've got some notes that I've written down here around what happened to the currency and the bond market in the days leading up to us being officially kicked out of the World Bond Index. We were downgraded, and there was quite a big fear around investors worldwide about what will happen to South Africa and the bond market. And I see that in the 4 days leading up to the South Africa actually being excluded from the World Government Bond Index, foreigners were net buyers of South African bonds. And so just to explain that, that means that, yes, some foreigners were selling bonds in those 4 days, but more foreigners were buying than they were selling. And so I think that that's quite a big thing to understand. That if they were correcting themselves and positioning themselves for a change in the bond market, you would think that they would have been net sellers. And I think what that tells me is two things. One, that foreigners have been correcting and positioning themselves for South Africa's exclusion for quite a few weeks, probably for quite a few months, in fact. And so what was interesting is to watch the bond market movements thereafter. And I'm going to ask you the hard questions now so that you can explain this to our clients. But I see that the yields on the 10-year bonds actually fell by 60 basis points. And so what does that mean? What is the effect of that? Is that good or bad?
Warren, it's good. What you have to appreciate is if I go to a bank with a bad credit record, I'll have to pay more in interest. And if I have a good credit record, or people are confident that I'll actually service the interest, I might get it at a lower interest rate. So when the bond market, the interest rate drops on the bond market, that means that in both investors and the borrowers, the investors are saying, I don't need that much interest, I can do with a little less interest. And the issuer of the bond, the South African government, can actually issue bonds at slightly less of an interest rate. But we must be very careful. In this whole COVID-19 plan of government, and we're in line with the rest of the world, already before this, the cost of servicing our debt was punitively high. If you were to break it down on a daily basis, which we don't pay, you pay it on maturity, usually quarterly or semi-annually, it's about R1 billion a day. That's going to move up. So although on the one hand, from a budget point of view, this is going to cost us, and we'll have to see how we restructure that. And Theo and Warren has already said that we will get an interim budget to try to show how we're going to manage that. But the other side of the coin is we do have access to capital, and in effect, the expectation of bond markets going through the roof, well, that didn't happen. Which shows you that it was discounted in the market. And remember, South Africa's real yield is one of the highest real yields in the world. What does that mean? That means somebody that invests in South African government bonds earns some of the highest yields in the world. And that kind of cushioned this big movement. But I think we need to be very careful. The South African market, specifically from an investor point of view, and I'm specifically referring to the equity market, there's three principles that everybody needs to appreciate. And those three principles are basically, number one, the JSE is not the South African economy. That's the first principle if you look at your investments. The second principle that you have to appreciate is the JSE is not the South African economy. And the third principle is the JSE is not the South African economy. People tend to try to think it's the same thing. Remember it is not the same thing. The JSE is a financial market. Most of the companies, most of the earnings is derived internationally, and it looks ahead. It wants to look 12 or 18 months forward. The economic numbers we get, the real economy, is what's happening to the man in the street. That's going to be terrible for the best part of this year, and it might not get better within the next 12 to 18 months. But remember, the JSE is not the South African economy.
I think it's it's interesting looking at the returns of the JSE and some of the companies over the first 4 months of the year, and interestingly that the sort of the four big companies are multinationals, and they're actually ended the first 4 months up and up by about 5% in total, whereas the balance of the JSE then was down, I think, about 26% over those 4 months. So you're right. I think, if you look at the smaller companies in the JSE, those are the banks and insurers and the like, that would be more related to what goes on here. And the bigger companies are the ones that are certainly driving the JSE in a different direction. And interesting, we've been inundated with web calls and webinars and Zoom calls by fund managers. So I've spent quite a bit of time listening to their views. What's fascinating is that they're openly admitting for the first time that they're quite confused about how the world unfolds. Normally they pretend to have a very strong view as to how things are going to unfold. And secondly, the increasingly now hearing them putting real optimism into their views on holding South African companies. So the real SA banks, the SA insurers, where they're not just saying, we'll hold them because they're in the index. Now they're saying, we're holding them because they're trading at PE ratios of 4 or 5 or 6. And they're expecting sort of double-digit growth from a lot of these real South African businesses in the months and years ahead. So I think you're right to caution people now. We would have loved to avoid have been able to avoid the hiding that the JSE has taken at the start of this year. It's not possible. And certainly, if you see the 14% jump in the JSE in the month of April, what it tells you is, market timing is absolutely a fool's game. It's impossible to have forecast that the world markets, including the JSE, would have jumped up 14% in a time when people are becoming increasingly fearful. So what we can say is that holding your South African businesses now, the likelihood of double-digit returns over the next 4 or 5 years is very high. The likelihood that they deliver the same returns that we've seen over the last 5 years is quite low. And that's the first time that we're seeing that sort of a view across the board from some of the more pessimistic fund managers that are typically not very excited about returns on the JSE. And I think the same would probably apply for a lot of the international markets, excluding America. If you look at the US, they've got a very expensive market when you look at the 5 or 6 big tech companies. And possibly the rest of the businesses in America are not so expensive anymore. But the rest of the world is looking decidedly cheap, and especially global emerging markets. So I must say, I think I'm fearful about what the economic damage will be to the world and to South Africa in the next few months. I think a lot of that bad news is probably priced into the JSE, but not into the American stock market. And I think that needs to come out in the wash. Most likely around June, July, we'll see more economic numbers, more companies reporting the results now that they've had a whole quarter in COVID in America. And I think it's going to be bad and it's going to be scary. But it's important to note that a lot of that bad news is in the price of the world's markets, excluding the American market. And we shouldn't be tempted to jump out in anticipation of bad news, which is possibly in the price already.
Yeah, I tend to agree with you. I think we're at the point where the best advice now is to, if you're an investor and you invest over a period of time, double up or triple your contributions if you can. And again, if you live off your investments, let's say, postpone big decisions, postpone big capital decisions, buying a new car or painting your house. It's simple facts, but at this point in time, I think markets are accurately discounting the negative news going forward. I think people should appreciate the news will stay negative for quite a while. There's a very good chance that COVID will come back with a second wave, which will again shock markets, which will again shock the headlines, which will make for great media exposure. But I wouldn't make major changes in the portfolio. And I tend to agree with you. Who would have thought that we'll have one of the biggest monthly gains in decades in the middle of the news of COVID becoming worse? You can't predict that, just like you cannot predict tops or bottoms.
And I think, one of the questions we're being asked at the moment by our clients is, what do we think of South Africa's prospects as an economy, as a country going forward? And so I'll give my initial views, and then you can perhaps just add or differ. And I think the one thing is, there's that old cliche about never waste a good crisis. And my optimistic scenario from here is that that the powers that be in government that are in charge of the economy, the hard economy, will use this as the opportunity to take the corrective action that should have been taken perhaps 18 months ago. And perhaps their hand has been strengthened by this crisis to now force the ideological debate out of the parliament and out of cabinet, so that there is a sole focus on the economy, on creating jobs, and stopping the wasteful expenditure. And so for me, if that's the action that gets taken by government in the next few months, and it needs to be in the next few months, that it cannot be delayed, then we could be in a position where the bounce from the huge damage that we are going to take could be a lot higher and a lot faster than what we would initially think. And if they structurally use this as a time to cut expenditure in government long term, in other words, the salary bill of government actually goes down permanently, and some of the wasteful state-owned enterprises are closed or restructured in a dramatic way, then the country could be on a path to a very different outcome to what we've seen in the last, I almost want to say 10 years now, where we've just felt like we're in the structural decline. So for me, that's our positive scenario from here. I think our negative scenario, the one that keeps me awake at night, is that the ideological debate continues, that we're sitting here in 12 months' time still trying to preserve fat state-owned enterprises with overburdened salary bills, a government sector that just carries on increasing wages at a time where they're not productive. To me, that would send us over a cliff that possibly we can't bounce from. But where we are right now, it is precarious, but I do feel that there is a very positive scenario from here if action is taken in the months ahead.
Warren, I'll even go one step further. We're going to be in a bad situation for the medium term. Don't think anything else. Don't expect anything else. Government's finances will be under incredible pressure. The balance sheet of individuals, the balance sheet of companies will be a lot worse. The income generating capacity of individuals, the income generating capacity of businesses will be a lot worse. But where I do agree with you is I think either government is going to implement the changes, and if government doesn't implement the changes, the IMF might dictate the changes. So either way, we have a choice. Whoever's going to implement the changes, we are due for changes. And I think that is the positive inevitability that we're probably going to have in the next 2 to 3 years. My view is that the power base within government is shifting. It is shifting towards the more rational, practical implementation side, away from the populist ideological side. And if that is going to happen, yes, it's going to be a rough 12 months, 18 months, 24 months, but the bounce back might prove over time that some of the right decisions were made in this time. So it's going to be a rough patch between now and probably the end of 2021. But after that, I hope that structurally, with new changes in place, the relationship between government and capital will be a lot sounder, to the extent that government will create an environment so that capital can thrive and create jobs.
And I think maybe as a wrap up to our clients that are wondering about what our recommendations are on things like currency, etc. We certainly think that the rand is far too cheap at these levels. If we look at some of the big banks and what their forecasts are, what we have to note first is don't rely on a big bank's forecast, because they're never right. But what is interesting is that they're forecasting somewhere between 1650 to 1750 for the rand by the end of this year, by the end of 2020. And our sense is that to convert your rands to dollars at about 1750 makes sense, and around about 20 rand to the pound. We wouldn't necessarily be sending money out when the rand's weaker than that. And I think the other question and the other debate point at the moment is cash. There's sort of a temptation by a lot of people to convert their portfolios to cash in anticipation of more bad news. And I think the forecast for money market funds, as an example, for the next 12 months will be a return of about 4.5% to 5%. So, we're used to, I'm not saying we're spoilt, but we are used to interest rates of 7 or 8% a year on money market funds and fixed income funds. We just need to know that the massive interest rate drops that we've seen means that we're going to get to the point where inflation might be at 3 or 4%, but interest rates are only going to be at 5%. And when you take off tax from that number, that means that you're going to be going backwards now. And I think so that real cash attraction that we've seen over the last 5 years, where cash has comfortably beaten shares, I think that dynamic has changed. I think so. So the temptation now to sit on too much cash to wait for things to get better, be careful. That's probably going to hurt you badly in the next year or two. So just we caution against that. We would say that maintaining your allocation to shares in this environment is right. It would be nice to miss the big drops, but they're not possible. And as we've seen, the biggest jumps happen in the worst times, and we've experienced that in April. So our view now is maintain your asset allocation. Don't jump out of the rand into the dollar or the pound at any exchange rate. It's not going to work for you. The likelihood is that we see emerging markets, including South Africa, start to strengthen once the world gets line of sight that the end of COVID is happening from a medical point of view. And that will be very positive for our currency and therefore our stock market as well.
Yeah, that's. I think I fully agree with you, and I think one needs to be very careful which media do you follow. There's an incredible amount of fake news out there. There's an incredible amount of wrong statistics, of things that you should certainly not use as a basis to make decisions.
And then, on a personal note, from both of us, we'd like to thank our clients for their patience and their understanding in times like this, and also just to reassure you that Galileo is fully up and running. We might be wearing pink shirts and black shirts in our home offices, but we're operating at full steam. In fact, we're probably as busy as we've ever been, and certainly are here, ready, willing, and able to help you where necessary. And if you feel like you need a call, please shout. We're always happy and willing to take your calls. We wish you all the best, and most likely we'll be doing another one of these in this format again, and until lockdown has eased somewhat. So thank you, and stay the course.